Once again, Dr. Michael Burry has taken to Twitter to share his sage wisdom. His latest tweet reads, 2000, 2008, 2023. It's always the same. People full of hubris and greed take stupid risks and fail. Burry's words are as epic as ever, and his cryptic lessons are not to be ignored. But why should we care? Burry's predictions have been spot on in the past, and his insights have helped countless people make informed financial decisions. So if you listen carefully and don't skip, you'll begin to understand the reasons behind Burry's warning, and this will help you stay ahead of the game. In a recent tweet, Michael Burry drew a parallel between the ongoing financial turmoil triggered by the collapse of multiple banks and the panic of 1907. Specifically, Burry compared the current situation to the events that unfolded when Knickerbocker Trust failed due to risky bets, leading to panic across other banks, just as JP Morgan intervened in 1907 to stabilize the markets. Burry believes that a similar measure has been taken over the past weekend to avert a crisis. Despite his reference to the panic of 1907, Burry does not see any imminent banking crisis. Rather, he is warning of a larger investment bubble that could burst at any moment. What could this be? Well, let's find out. In 2019, Michael Burry articulated his concerns regarding the surging popularity of index funds, which he believed was resulting in overpriced stocks and larger indexes, dubbed as the passive investment bubble. This phenomenon arises because fund managers are compelled to invest in all companies listed in the index, regardless of their merit. Consequently, this creates a frenzied buying activity that can obscure the actual worth of these stocks. Burry's previous success in predicting the housing bubble that led to the 2008 financial crisis and his investments in GameStop have made him a notable figure in the financial world. However, he remains steadfast in his warnings about the stock market investment bubble. In a tweet from late 2022, Burry pointed out that the difference between now and 2000, also known as the dot-com crash, is the passive investing bubble that inflated steadily over the last decade. All theaters are overcrowded, and the only way anyone can get out is by trampling each other, and the door is only so big. He believes that the current market collapse could be worse than the dot-com crash, given the significant amount of money invested in index funds. Burry's warnings serve as a reminder that bubbles can exist in any market, and passive investing may not always be the safe choice it is touted to be. Now, what does Burry mean by passive investing? Picture this: you're walking on a tightrope trying to balance yourself, but one wrong move and you could fall flat on your face. Investing in just one company is quite similar. If the company you've invested in fails, your entire investment could be wiped out. With that being said, passive investing is a strategy that diversifies your investment across a group of companies, reducing the risk of losing it all. The crown jewel of passive investing is the S&P 500, a basket of 500 behemoth companies that represent the backbone of the American economy. By investing in this elite group, your money is intertwined with the fortunes of numerous companies, providing a safe and stable investment option. However, Burry's concern centers around the booming popularity of passive investing, a strategy that involves pooling your money into the SPY ETF and low-cost S&P 500 index mutual funds. This trend has exploded in recent years, with Bloomberg reporting that a staggering 21.2% of all S&P 500 company shares are now held inside passive funds, a stark contrast to just 3.3% in 2003. But why the sudden surge in passive investing? Well, the answer lies in the belief that these funds will always go up over time. It's an easy and comfortable investment strategy, especially for those new to the market. Even investing legends like Warren Buffett have sung the praises of the S&P 500, recommending it as the best option for most passive investors. This is how he explains it.
March 31st, I ran off a list of the 20 largest companies in the world. I would now invite you to look at slide 2, or L2, which goes back a little more than 30 years, and look at the top 20 from 1989. 1989 was not the Dark Ages. I mean, we weren't just discovering capitalism or anything else. And people thought they knew a lot about the stock market and the efficient market theory was in, and it was not a backward time. And if you look, the top company at that time had a market value of 100 billion, 104 billion. So the largest company in the world, title, in just a shade over 30 years, has gone from 100 billion to 2 trillion. At the bottom, the number 20 has gone from 34 billion to something a little over 10 times that. One thing it shows, incidentally, is that it's a great argument for index funds, is that the main thing to do was to be aboard the ship, a ship. They were all going to a better promised land. You just didn't know which one was the one they'd necessarily get on. But you couldn't help but do well if you just had a diversified group of equities.
So, it's quite clear that Warren Buffett is a strong advocate of index funds and recommends them to investors as one of the smartest long-term investment strategies. He has even suggested this approach to LeBron James in the past, indicating his enthusiasm for the investment vehicle. You may wonder, is this strategy really foolproof? Well, not according to Burry. He warns that the long S&P 500 investment may have become a crowded trade, requiring constant buying power to sustain current price levels. History has shown that achieving profits in the stock market and realizing those gains on the exit are two very different things. The bulls of the early 2000s discovered this the hard way during the dot-com and tech bubble. And now Michael Burry is predicting that the bubble could burst if holders start losing faith in the system and exit in large numbers. So on one hand, you've got Buffett taking time at the Berkshire Hathaway annual shareholders meeting to spend 15 minutes talking specifically about passive investing. And then on the other hand, you've got Michael Burry saying this is a crazy bubble that could burst at any time. Why are there differing opinions between two investing giants? The main reason for their differing opinions is their time frame. Burry focuses on the present and the next 5 years or so, using his research to make investment decisions. He was ahead of the curve in identifying the housing bubble in the early 2000s. Burry sees problems with passive investing on the horizon, but Buffett's perspective extends far beyond the immediate future. He recommends index funds not for their current or short-term potential, but for their long-term value, suggesting holding onto them for decades, even 50, 60, or 70 years. Buffett's philosophy is based on his belief that over time the stock market will increase in value, and the benefits of low-cost index funds will compound. He advises against trying to time the market or chase after the latest fad. In contrast, Burry is skeptical of the current market trends and sees a bubble forming, which could lead to a sharp downturn. Burry's prediction highlights the potential risks associated with passive investing, which he believes may lead to an unsustainable bubble. If the holders of passive investments start exiting in large numbers due to a loss of faith in the system, it could have disastrous consequences for the market's overall stability. In addition to this, Burry's warning underscores the importance of active investing, where investors conduct thorough research on individual stocks and make informed decisions based on sound investment principles, rather than blindly following the index. Now, while this prediction is concerning, it's important to acknowledge the complexity and unpredictability of the market. Numerous variables impact market performance, making future predictions impossible. Nonetheless, you can take measures to diversify your portfolio and stay up to date on market trends to reduce your risk and safeguard against abrupt changes in investor sentiment. Thanks for watching, and we'll see you in the next video.